So let's just talk about setup considerations. And one of the things I always say to people is, what are your long-term plans? I do hear a lot of people saying, well, I need a limited company because I've seen this on Facebook. I've been to a network event. If I don't have a limited company, then apparently my skin falls off my skull and the blood drains from my veins, and I will be just a puss really on the floor. And that's not true, is it? Because ultimately a limited company is there as a vehicle to help you reduce tax. It's not the be-all and end-all, really. So you need to think about your long-term plans. And as I mentioned in my previous conversation with Mike Stenhouse, the podcast, he asked a very good question of saying, well, people that are thinking about leaving their job in 2-3 years' time, is it really worth them setting up a company if, in the meantime? And I was saying, well, not really, because the amount of mortgage interest, extra cost that you will have probably overweighs the tax benefits of a limited company anyway. In addition to that, when people are setting up properties for the first time, they're normally doing a lot of refurbishment costs, which means that they've got a loss. Well, if they kept the properties in their own name with a cheaper mortgage rate and they've got a loss being built up, then they're not paying tax, irrespective of Section 24 changes. So if people are thinking about leaving their company, leaving their employment, then I don't think it's really appropriate to have a limited company. So you do need to think about your long-term plans before you set that up. What income do you have in your personal names? Now, it could be the fact that you might want to drop down a few days from your work or start to phase yourself out of the employment rat race. And again, if that is the case, then should you be using a limited company? Maybe, maybe not. And what income do you want now and in the future? And that's an interesting thing. And I'm going to cover that off in later on with a good example of what is your lifestyle needs and what do you need from your properties. And do you have children to pass assets on to? It's one thing, you can't really transfer properties to your children. And the reason for that is because you may have a capital gains tax liability, you've got mortgages to worry about, but you can transfer shares of a limited company to your children. So this is something where we talk about IHT mitigation and new transfer of shares over time. I'm not going to go too much about that, but what I want to talk to you about is this. When people are setting up limited companies, I would always say that they should have two companies, one being an investment company and one being a trade. What is the difference between the two? Well, an investment company is one that will buy and hold properties in their company. And then a trade company will have flips. So something that you may go off and buy property, refurbish it or develop it and then sell it on. You may also have services. So you may have a IT contracting business, or what you might sell professional services, or you might have holiday lets on acting as an agent. All of those should be in your trade company. And the reason for that is simple. If you close down your trade company, you may get the entrepreneur's relief tax that I talked about already at the beginning of this. So if you close down that company, took all the money out of it, you would have a capital gains tax rate of 10% because of entrepreneur's relief. You wouldn't get that in your investment company. And equally, what I would say to you is if you're doing a huge development property, do not mix that with your investment buy-to-let properties in this company, mainly because of risk. If something should go wrong with that particular property, such as a tile hits someone on the head as they was passing by, they could sue you as a director, and that could have connotations. And what that means is every asset within that company could then be subject to be a compensation claim. So therefore, you want really risky projects to be isolated from anything else that you've got going on there. You can extract money out of a limited company using wages. And in this, I mean, if you're not getting any other form of employment income or property income, then it is worth you considering taking wages out of your limited company. And right now we're saying, well, if you take out $8,424 from your limited company as an annual wage, then you won't have any income tax liabilities, and you won't have any national insurance charges, either as an employee or as an employer. I'm going to do another webinar about employing yourself and other people in a future webinar, maybe in 2 weeks' time, because that's a whole big subject. So make sure that you listen to that. That'll be very, very useful for you. You can also use dividends, ABC structures. Now, we've had a couple of issues, restructure issues, whereby couples have got together. They have an investment company, and what's happened is that they've got ordinary shares each, and they want to pay dividends. But what's happened is they thought that they could use different amounts of dividends for those ordinary shares. Sadly, that's not the case, because if you've got ordinary shares, you must, if you've got the same number of shares as well, you must pay the same amount of dividends on there. And that's why we say use ABC shares. So one person might have A share, another person might have a B share, and if you've got a third party going on in here, then you may have a C share going here as well. And it just allows you to pay different amounts of dividends to ABC shareholders. For tax planning, that is fantastic. So that's all I'm going to talk about on that slide. But I'm going to give you a scenario here. It's always good to have an example for you to bring it to life. And here we've got a couple, Sarah and Dave. Now, Sarah is a high rate taxpayer. She's a medical consultant, a bit like Jane, and she wants to work for another 5-10 years. Okay, so she's happy in her job. She doesn't really want to change. She may even get promoted at some point in the future, so she's happy. Dave, on the other hand, is self-employed photographer, doing really well for himself, but he's looking to replace his income within 3-4 years from that property portfolio. And here what we'd be thinking, what we're saying to Dave is, well, actually, is it worth you thinking about keeping the properties in your names, but most of the income going to Dave, and they're just accepting that Section 24 may affect you a little bit, but in 3-4 years' time, when you're disposed of your trade activity, your photography business, then could you be a basic rate taxpayer, even with Section 24 coming to affect you? And if that's the case, then why have a limited company at all? But, let's be honest here, we could be talking about plans of 3-4 years. He might love his photography business, and he may actually say, well, I'm doing so well in properties, I want to buy lots more, but I can only do that if I have the profits from my photography business to do it. So therefore, let's keep on going. So sometimes I would say that plans, we will always work with our clients, but we must also be aware of, well, what if it happens? What if it doesn't happen in the way that you expected? What are the tax pitfalls? And we'll always have that open, frank conversation with our clients. This is an example where I wanted to bring to life when it's useful to have a limited company and when it's not. Now let's imagine that you're a sole trader, so self-assessment client here, and you've got £100,000 profit, and instead of having it in your own name, you have the same £100,000 in your limited company. What you was going to do with all that money is just simply extract it out. You were kind of saying, well, no, happy to extract as much money as I can after tax to myself. So how much would I pay tax? Now you'll notice as a sole trader that, and I've put in national insurance in here just for the people that got trade income, like the photographer. But if we just talk about property right now, you'll notice that there's an income tax charge of just $28,350. Now it does ignore Section 24, so forgive me on that, but I wasn't quite sure how to do that. And when you compare that $28,350 compared to someone who simply wants to extract that £100,000 out of the limited company, please note there's no national insurance charges here. There is a total tax charge of £36,000. So you could argue, well, why did you put things in a limited company if you're going to be paying £8,000 worth more tax? And the simple truth is that, if you are setting up a limited company and you're simply going to extract all of the profits that's been generated out of that company, then I don't think that a limited company really is useful at all. So let's take a look at an example when it could be useful. Same example for the sole trader, so £100,000 worth of profits. If you got a trade, then we'll have to think about national insurance, but we're going to ignore that. We're going to focus on just property investors here. So we've got $28,350 generate tax as a result of that £100,000 profit. And what we've also got going on is that this is in the company £100,000, but what we're doing is being sensible. And I don't mean that cynically, but we're being sensible of how much money we extract out of the company. So we're saying £50,000 for one person, by the way, and they're leaving the rest of the £50,000 in that company to reinvest in property, which I think is a very good and sensible idea. That means that if we look down the bottom now, that the tax charge is £20,000, and even if we ignore national insurance, that's still an £8,000 tax saving as a result of using a limited company structure. We do need to think about, again, the mortgage interest, higher cost that's going to be in a limited company than in your sole name. Is it really worth it then if you compare the higher rate interest charges to this scenario? And that's where I would say to you, it's probably worth having a look at the rates of mortgages that you can get in your name versus a limited company, and then saying, well, how much mortgage interest will I be actually paying? Does that save me the £8,000 as shown as a tax saving? And that's something that you'll need to work with us and your mortgage broker on. That gives you an example, and the kind of conversations we have is leading on to this. So 123 Limited Company is set up as a limited company. It's an investment company because it's looking to buy and hold these assets over here. And what we're going to say now is David now has got A class shares, Sarah's got B class shares. Don't forget here, we're now being able to give David more dividends than Sarah is going to take. Sarah can, of course, take £2,000 worth of dividends tax-free wherever she wants to. So that's in the bag. But David may take out £30,000 worth of dividends for their lifestyle purposes. And the last bullet point is just reconfirming that mortgage interest rates are normally 1 to 2% more in a company structure. We are seeing those rates coming down in a company structure, and it won't be long before the interest rates, from my view, will be pretty comparable to what you can get in your own name. So then, guys, what we talk about here is an example of accounts that need to be submitted to both Companies House and to HMRC. So if we started a company in 1st of January 2018, it will have a year end because it's a 12